Hello everyone, and welcome back to the channel. It is great to have you here with us today. We need to have a very serious conversation about the political war on money that is happening right now in our economy, because the headlines you are seeing are misleading. You are seeing celebrations about 10% credit card caps. You are seeing hype about mortgage rates dropping to 6%. And you are hearing over and over again that this is a massive victory for the American consumer. But I need you to pause and ask yourself a critical question based on the title of today's discussion. Are these 10% interest rates actually a gift, or are they a trap? And more importantly, when we look at the 47 million Americans who rely on access to credit, we have to ask, who loses? Because in this scenario, someone always loses. Before we dive into the mechanics of this, I want to hear from you. What is the annual percentage rate on your primary credit card right now? Is it 15%, 25%, maybe even higher? Drop a comment below and let me know, because I want to see how many of us are actually feeling this squeeze right now. What you're witnessing right now in January of 2026 is arguably the most dangerous experiment in American monetary policy since Richard Nixon took us off the gold standard. We are watching a fundamental shift. The President of the United States has effectively declared war on the price of money itself. And if history has taught us anything, it is one brutal lesson. When governments start manipulating the cost of credit for short-term political gain, somebody pays the price. And usually, that somebody is you and me. We have reached a point where stock prices no longer reflect corporate earnings. House prices no longer reflect the reality of supply and demand. And interest rates no longer reflect risk. Everything, and I mean absolutely everything in this market, now reflects one thing only: the president's desire to win the 2026 midterm elections. Welcome to the era of political money. Welcome to the great repricing. If you do not understand the mechanics of what is happening right now, you are at risk of getting wiped out. Let me paint a picture of exactly what is happening in Washington at this moment. On one side, you have President Donald Trump, fresh off his victory in 2024. But now, he is staring down the barrel of the 2026 midterms. His entire political survival depends on making Americans feel like life is affordable again. The pressure is immense. Credit card debt has hit $1.23 trillion. The average annual percentage rate is sitting at 21%. Mortgage rates were hovering at 7%. His voters are angry, and they want relief. On the other side of this conflict, you have Jerome Powell in the Federal Reserve. Since 1913, the Federal Reserve was designed to be independent from political pressure. The entire purpose of the Fed is to make the unpopular decisions, to raise rates when inflation runs hot, even if it costs a president an election. That independence is supposed to be a firewall protecting our currency, but frankly, that firewall is burning. On January 15th, 2026, the Department of Justice served grand jury subpoenas to the Federal Reserve. Now, the stated reason for this was cost overruns in the renovation of the Eccles building, the Fed's headquarters. But come on, let's be real. Everyone in Washington knows that is just a pretext. It is the legal groundwork to remove Jerome Powell for cause before his term expires in May. Here is what you need to understand about the law. Under the Federal Reserve Act, the president can only fire a Fed chair for inefficiency, neglect of duty, or malfeasance. Simple policy disagreement does not count. You cannot fire him just because he won't lower rates. But if you can prove something, anything that smells like misconduct, you have your opening. This is not speculation. This is the playbook being run right in front of our eyes. The markets understood this immediately. Within 48 hours of the DOJ announcement, gold blew past $4,600 an ounce. A record high. The dollar weakened against the euro and the yen. And bond traders? They started selling treasuries. They did not sell because they thought organic inflation was coming. They sold because they thought the Fed would be forced to let inflation come. This is what analysts call the sell America trade. It is what happens when global investors decide that United States assets now carry a political risk premium. Let me say that again. Political risk premium. That is a term we use to reserve for developing economies like Turkey, Argentina, or Venezuela. Now that term applies to the United States of America. Now that we understand the high-level political game, let us zoom in on what acts as a credit card trap and creates a vast credit desert for millions of Americans. On January 20th, 2026, exactly 1 year after his second inauguration, President Trump's credit card rate cap takes effect. The number is simple, 10%. No credit card in America can charge more than that. On the surface, it sounds beautiful, doesn't it? It sounds like a victory for the little guy against those greedy Wall Street banks charging 25 or 30% interest. But let me show you why this is a trap. To understand why, we have to look at how credit card pricing actually works. The base cost of funds for a bank, the money they have to pay to get money, is tied to the prime rate. Right now, that is 6.75%. A 10% cap leaves exactly 3.25 percentage points of margin. That is it. That tiny sliver of margin has to cover everything. First, it has to cover credit losses. For prime borrowers with great credit, that might be 2 to 3%. But for subprime borrowers, people with FICO scores below 660, default rates can exceed 10%. Then you have operating costs, customer service, fraud detection, transaction processing. That costs another 2 to 3%. Banks also have to hold reserves against these loans. And remember those airline miles you love, those cashback points? They are subsidized by interest income. When you do the math, a 10% cap simply does not work. It is not even close to profitable. The American Bankers Association ran the numbers, and the results are terrifying. Under a 10% cap, between 82 and 88% of all credit card accounts become unprofitable. Not just marginally unprofitable. We are talking deeply, existentially unprofitable. So ask yourself, what do banks do when an account costs them money? They close it. This is the part that keeps me up at night. This is where we talk about those 47 million Americans with subprime credit scores, FICO scores below 660. These people are not going to stop needing credit just because the banks close their accounts. When your car breaks down and you need $800 for repairs so you can get to work, you do not have the luxury of waiting 6 months to save up. You need that money now. I want to pause here for a second. Do you think a 10% cap is worth it if it means millions of hardworking people lose access to credit entirely? Or is this a necessary blow to the big banks? Let me know your thoughts in the comments. I'm curious to see where you stand on this. So, where do they go if they cannot use a credit card? They go to the fringes of finance. They go to payday lenders, where the effective annual percentage rate is 300 to 400%. They go to pawn shops. They go to title loans that put their car at risk of repossession. And in the worst cases, they go to illegal loan sharks. The cruel irony here is devastating. A policy designed to protect consumers from 25% interest rates will push millions of them into paying 400% interest rates or worse. We are pushing them into the hands of people who break kneecaps instead of charging late fees. Dr. Samuel Gregg at the American Institute for Economic Research called it perfectly. He said, "We are creating credit desserts for the people who need credit the most." And please, do not think this is just about Wall Street banks protecting their profits. America's psychedose credit unions, those member-owned cooperatives that exist solely to serve underserved communities, have come out swinging against this policy. In a letter to the president, they called it devastating. These aren't executives protecting bonuses. These are community institutions warning that they will have to stop lending to their own members. And for those of you with good credit, thinking you are safe, think again. Those airline miles you have been collecting, those 2% cashback cards, they are gone. The entire rewards ecosystem is funded by the cross-subsidy from borrowers paying high interest. When that interest income disappears, so do your points. Every free flight, every hotel upgrade, it has been paid for by someone carrying a balance at 24% APR. Kill that revenue stream, and the entire system collapses. But credit is only one part of the equation. We must also shift gears to discuss the critical triad of housing, inflation, and your economic survival, because the manipulation there is just as aggressive. On January 8th, 2026, President Trump directed the Federal Housing Finance Agency to order Fannie Mae and Freddie Mac to spend $200 billion of their retained earnings buying mortgage-backed securities. The goal is simple: flood the market with buy-side demand, drive up bond prices, and push mortgage rates below 6%. And sure, it worked for about a week. Rates dipped below 6% for the first time in 3 years. The headlines celebrated. The president took a victory lap. But here is what those headlines did not tell you. Fannie Mae S net worth as of the third quarter of 2025 was $105.5 billion. Freddie Mac is smaller. Combined, these institutions, which backstop the entire American housing finance system, have roughly $170 to $180 billion in capital reserves. The president just ordered them to spend $200 billion. Let that sink in for a moment. He's ordering them to spend more money than they actually have. Since the 2008 financial crisis, Fannie and Freddie have been operating under strict capital requirements. The whole point was to build up a safety buffer so that if housing prices crash again, taxpayers wouldn't have to bail them out. That buffer is being burned right now to buy votes in a midterm election. And here is the real trap with housing. Mortgage rates affect demand. When rates drop, more people can afford to buy. But what about supply? The United States housing market has a chronic shortage of inventory. We are millions of units short. Plus, we have the lock-in effect. Homeowners who bought in 2020 or 2021 with 3% mortgages are not selling. Why would they trade a 3% mortgage for a 6% one? No chance. I know many of you watching are homeowners. Are you one of those people locked in to a low rate who refuses to sell? Or are you a buyer waiting for that 6% rate only to realize prices are jumping even higher? Tell me your situation in the comments. Are you staying put, or are you trying to move in this chaos? So, when you inject $200 billion of demand into a market with fixed supply, what happens? Prices go up. That is economics 101. The affordability benefit of lower rates gets eaten up immediately by higher home prices. You're not helping first-time buyers. You are helping existing homeowners get richer while pricing the next generation out entirely. It is a shell game. Let's zoom out and look at the bigger picture. We are at roughly 3% inflation right now. The Fed's target is 2%. The textbook response is to keep rates elevated until inflation cools. But what if the president forces the Fed to cut? What if he gets his wish for cheap money? Cheap money keeps zombie companies alive. These are firms that can only survive because their debt servicing costs are artificially low. They do not create value. They do not innovate. They just exist, consuming capital that should flow to productive enterprises. In a healthy economy, when rates rise, weak companies fail. It is painful, but it is how capitalism renews itself. When you suppress rates for political reasons, you freeze this process. The zombies keep walking, the bubbles keep inflating. And when the correction finally comes, and it always comes, it is catastrophic instead of manageable. This is exactly what happened in the 1970s. President Nixon pressured Fed Chair Arthur Burns to keep rates low ahead of the 1972 election. Burns complied. Inflation exploded. It took Paul Volcker and a brutal recession with 20% interest rates to finally kill it. We are walking that exact same path today. So, what does the future look like? We are entering an era of financial repression. This is a strategy where the government keeps interest rates below the rate of inflation. Effectively, it is a hidden tax on anyone holding cash or bonds. If savings accounts pay 3.7%, but real inflation is higher, your real return is negative. You are losing purchasing power every single day. Why does the government do this? Because with $34 trillion in debt, negative real interest rates make the debt easier to manage. They are paying it down through inflation, and the holders of that debt, pension funds, retirees, are the ones taking the haircut. So, what do? How do you protect your wealth when money becomes a political tool? I am not a financial advisor, but I can tell you how to think. First, understand that cash is no longer a safe haven. When rates are suppressed, cash is a guaranteed loss. Second, hard assets matter more. Gold hit $4,600 for a reason. Real estate, despite its problems, holds value when currency doesn't. Third, diversify geographically. The Sell America trade suggests having some exposure outside the dollar makes sense. And fourth, reduce your debt. The 10% cap might feel like a gift now, but when it expires or snaps back, you do not want to be trapped. There is one final, darker layer to this story that we need to confront before we finish, and it is arguably the most painful betrayal of all. It is the destruction of the unspoken social contract that has held the American middle class together for generations. For the last 50 years, the rules of the game were supposed to be simple and fair. We were told that if you worked hard, if you lived within your means, and if you saved your money in a bank or a conservative portfolio, you would be okay. You were told that your savings were the bedrock of your future liberty. But what happens when the government fundamentally breaks that promise? When interest rates are manipulated downwards by political decree, the act of saving money transitions from being a prudent virtue to a guaranteed path to poverty. This is not an accident. It is a transfer of wealth. Economists call this the Cantillon effect. When new money is printed or credit is artificially cheapened, the people closest to the spigot, the government, the big banks, and the major corporations, get the value first. They get to buy assets, buy back stock, and acquire real estate at today's prices. By the time that money trickles down to you in the form of wages, prices have already risen. You're getting the diluted leftovers of your own currency. This creates a permanent two-tiered society that is fundamentally un-American. You have the asset owners on one side, who see their portfolios inflate and cheer for the wealth effect. On the other side, you have the wage earners and the savers, who see the cost of groceries, insurance, and healthcare sprint away from them faster than their paychecks can ever catch up. This is why you feel like you are running on a treadmill that is speeding up every single month. It is not in your head, it is in the monetary policy. The ultimate danger here is not just economic, it is institutional. The United States dollar is the reserve currency of the world, not because of our military might alone, but because of trust. The world trusts that our financial markets are open, fair, and ruled by law, not by the whims of a political calendar. When we start firing Fed chairs for following the data, when we start setting price controls on credit cards, and when we start commandeering the reserves of housing agencies to buy votes, we are lighting that trust on fire. If the world decides that the dollar is no longer a neutral store of value but a weaponized political tool, they will walk away. We are already seeing the cracks. Central banks around the world are buying gold at a pace we have not seen in decades. They are diversifying away from treasuries. If that trend accelerates, The privilege that allows us to run $34 trillion deficits evaporates. Interest rates will not just go up, they will skyrocket. Not because the Fed wants them to, but because no one wants our debt anymore. So as we stare down the barrel of 2026, understand that this is about more than just a 10% credit card rate or a cheaper mortgage. It is a battle for the soul of the American economy. It is a choice between a system where price signals guide free people to make rational decisions, or a system where bureaucrats and politicians decide who wins and who loses. The gift of lower rates is the bait. The trap is a future where your money is not yours, and your savings are fuel for the government's fire. We are living through a fundamental transformation of how money works in America. Price signals are being overwritten by political signals. History calls these managed economies, and they tend to end badly. The question isn't whether the mistakes of the 1970s will be repeated. The question is whether we will learn from them before the damage becomes irreversible. I want to leave you with one final question to answer in the comments. Do you believe the American middle class can survive another decade of this financial repression? Or are we witnessing the beginning of the end for the dollar as we know it? I want to see a real debate down there, so don't hold back. I'm not optimistic, but I am prepared, and you should be too. Thank you for watching.